So with that, we're going to wrap up with some talk about the US economy. And the reason we're going to wrap up with the talk about the US economy is because there's been a lot of talk all across social media. We're talking TikTok, YouTube, Facebook, Twitter, Reddit, like everybody is talking about the economy. It's the first thing on most people's minds. And there's a lot of mixed signals to say, all right? There's a lot of discussion, chatter about whether or not we're in a recession, if that matters, how bad is that recession, etc. And the reason for that, as I just stated, is because the signals that we're getting from everywhere, it's a mixed bag. So we're going to talk about that. So let's go ahead and get into it. Now, the economy continues to give mixed signals with signs of robust job strength, declining demand, and inflation. These signals are creating a muddled picture of whether US or even the world economy is in a state of recession or not. Across social media, we've seen arguments that the United States has entered a recession due to 2 consecutive quarters of declining GDP, a rule of thumb, but not necessarily the rule. So we're going to talk about these signals and what they can mean. First up on that, we'll be looking at the July 2022 Service Industry for Supply Management Report on businesses. Quoting from the person that wrote the report, quote, "The price index decreased for the 3rd consecutive month in July, down 7.8 percentage points to 72.3%. Service businesses continue to struggle to replenish inventories as inventories index contracted for the 2nd consecutive month. The reading of 45% is down 2.5 percentage points from June's figure of 47.25. The inventory sentiment index, 50.1%, up 3.9 percentage points from June's reading of 46.2%, moved into expansion territory in July after 4 consecutive months of contraction. To basically put that in non-economic lingo, essentially we're seeing inventories begin to rebound and supplies replenish, which means that we're seeing the supply crunch that we experienced over the last year to be coming back into alignment to meet where supply and demand are more in line. However, it's not all rosy. It's not all peaches and cream because companies are still having trouble replenishing their supplies. And that's why we saw that the supply inventory shrink a little bit and continue to struggle. Continuing, the report continues though. According to the services PMI, 13 industries reported growth. The composite index indicated growth for the 26th consecutive month after a 2-month contraction in April and May of 2020. Growth continues at a faster rate for the service sector, which has expanded for all but 2 of the last 150 months. The slight increase in services sector growth was due to an increase in business activity and new orders. The employment index contracted for the 2nd consecutive month, though, and the backlog of orders index decreased 2.2 percentage points to 58.3%. Availability issues with overland trucking, a restricted labor pool, and various material shortages and inflation continue to be an impediment for the service sector. Now, to put that into non-economic lingo speak again, essentially what we're seeing here is that we're seeing that while new orders are coming in, while businesses are continuing to grow, they're hitting headwinds in terms of labor pool shortages, which means that there's too many jobs and not enough people to fill them. We're still seeing material shortages in various sectors, and inflation eating away at people's ability to buy different goods and services as people move from discretionary spending to mandatory spending. That's a bad way to say it. As people move from buying things and experiences to necessities, as necessities take up more of their budget. So with all that said, though, according to this particular report, this report being the Service Institute for Supply Management report on businesses, the economy is still doing well. There's still growth, job reports are robust, and companies are starting to replenish inventories. These are all good signs. But Another report, the S&P Global U.S. Services Purchasing Managers Index report, paints nearly the opposite picture. Now, according to this report, while new orders for goods and services returned to a growth outlook, overall business activity declined from June to July. According to Chris Williams, the chief business economist at SP Global Market Intelligence, quote, tightening financial conditions mean that financial services sector is leading the downturn, with a further steep rise in interest rates from the Fed, since the survey data were collected likely to intensify the downturn. Higher interest rates, alongside the ongoing surge in inflation, have meanwhile spilled over to the consumer sector, meaning the surge in household spending on goods and activities such as travel, tourism, hospitality, and recreation seen in the spring has now moved into reverse as household spending is diverted to essentials. Although employment continued to rise in July, the rate of job creation has also slowed sharply since the spring, and looks set to weaken further in the coming months as firms cut operating capacity in line with weakening demand. The flip side of this deterioration in demand, though, is a welcome alleviation of price pressure, which hint at peaking of inflation. So what does that mean? Well, that means that essentially, as I stated earlier, as people move some discretionary spending on like things and goods and services to necessary spending such as fuel prices, food, etc., you're going to see weakening demand lead to weakening market and potentially also a decline in inflation. So bolstering the S&P Global aforementioned report, consumer confidence has also fallen for the third straight month. However, consumer confidence is well above historic levels, well above the levels seen during a recession historically. With that said, the consumer's outlook for the next 6 months held steady, but at levels that suggest a recession fears remain persistent. In fact, about 43% of respondents say they think there's a greater than 50% chance that the US will experience a recession in the next 12 months, while just 13% of respondents said that as of April. But while this may be the case, this week's job reports look also to offer mixed signals. Jobless claims slightly increased this week to a seasonally adjusted average of 260,000, but layoffs for the first half of the year is down 31.3% from the same period last year and the lowest since the January to July time span since 1993. Now, job cuts this year have been concentrated in the automotive, technology, and financial sectors. Semiconductor shortages have hampered the auto industry, while layoffs in technology and financial sector reflect cooling demand because of higher interest rates. Now, furthermore, it is expected while the job market may cool some with the tomorrow's jobs report, there will still be more job openings than people looking for work. In June, the rate was 1.8 job openings for every person seeking work. Now, there's other mixed signals here as well. We see a further decrease in gasoline prices, and gasoline prices have fallen for the 7th straight week, with the average dropping from roughly $4.70 national average to roughly $4.10 on national average. And some states, such as my state of Texas, have seen gas prices in some areas drop below $3.50 a gallon. Now, this could be a result of more supply coming on, or it could be a result of further reduction in demand. And while it might feel good, people are still worried about a recession, and so that is impacting consumer confidence. And with all that, the Fed is continuing to raise interest rates, with just this week raising another 0.75 basis points, from pulling it in from 1.75 to, roughly 1.75% to 2.25 to 2.50% for interest rates. U.S. oil prices have also fallen below $90 a barrel for the first time since February. But stocks on all this news have actually gone up because stock market analysts and investors are actually seeing this as a good measure in order to tackle inflation, as well as seeing the further jobs reports that we're seeing and the job growth that we're seeing as positive signs that the economy is actually pretty stable. So we're going to turn over now to a article from the Washington Post that will compare the data that we see from the last 6 months to other historic recessions. So let's talk about that a little bit here. So last week's report on economic output recharged speculation about whether the US economy is actually in a recession. Gross domestic product shrank for the second quarter in a row, a common but not official definition of a recession. GDP isn't the only measure that matters, especially in a tangled mess of pandemic economy. The National Bureau of Economic Research, the NBER, has the final say on whether a period of economic decline is a recession, a determination that can actually lag for months. The NBER economists consult a wide range of indicators that suggest this year's economy stands on sturdier ground than in recent recessions. We're going to go ahead and pull up this chart here. Okay. Now, what you can see on the screen here, is you can see this year highlighted in yellow with past recessions when it comes to various different measures of what a recession means. So from left to right, top to bottom, we see non-farm employees, which means any employee, any person working in a non-farm related sector, to have really declined way more last 6 months, rate of a recession. 6 months before downturn, 6 months downturn, first 6 months, way more than what we're seeing right now. In fact, some of it, oftentimes, as you can see with these lines here, oftentimes it actually goes negative. Okay, like it lowers below 0%, which means that we've had major job losses rather than seeing job growth. Employment levels, same thing. Industrial production, those just fall off a fucking cliff. Like in most recessions, we're not seeing that, at least not yet. With the recession that we might be in, same thing with gross domestic income. You can see those, like you see a surge and then a sharp decrease. Not seeing that yet higher either. Personal consumption, again, can fall off a cliff, go negative. Same thing with gross domestic product. Personal incomes and manufacturing just craters, man. Craters in most recessions. Just absolutely falls off a cliff. And manufacturing is the one that kind of here that actually looks to be following the general trend of of previous recessions. Personal income a little bit there as well, at least compared to like one or two other recessions, but they don't seem to be following the same historic lines, the same historic outlook that we get in most recessions. And that is important to point out, because if we are in a recession, then the most that you could say as of right now is that we're in a very mild one. And I've been saying this for forever, like not just these last 3 weeks, not just when Biden's been president, not just when Democrats are in power. I've been saying this forever. Okay. A recession that isn't accompanied by job losses in multiple percentage points isn't worthy of the name of a recession. Okay, so when I recorded this last night, the jobs report had not come out yet, and it just dropped this morning, roughly about, I think it was about 8 a.m. Eastern Standard Time. And what we're seeing here is that we had double the amount of job growth that we had last month in June. Went from roughly 250,000 jobs to 528,000 jobs. Huge news. And it just goes to show you, like we said earlier in this program, that if you have this strong of job growth, it really does belies the idea that we are in this really big recession, or that we're getting into a recession that is worthy of the name. We can go over to the news article really quick about it, but I don't think that's entirely necessary. You can see this all across social media. Just need to reiterate that we added so many jobs that I really can't see us calling this a recession. I just can't. If you don't have if it doesn't come with negative growth, where you actually have a contraction in the economy, if you still have growth in the economy, you don't have a recession that's worthy of being called one. You don't have this broad category of people that are just being absolutely hammered by what's going on. You have certain sectors maybe that are experiencing a correction, or maybe the entire economy itself is experiencing a minor correction, but you're not seeing this massive wave of layoffs, massive wave of foreclosures, maybe not even massive, but don't see a bunch of foreclosures. You don't see people completely losing their shirts in the stock market. You see a decline in growth. You see a decline in GDP, but you don't necessarily see it as broad across the economy, broadly across all income sectors, as what most people consider a recession to be. This isn't to say that it doesn't suck. It is just to say that even though people might feel as though we're in this terrible, terrible state, and we're in a pretty bad state. I don't want to diminish the fact that inflation sucks ass and it's fucking everybody right now. Okay? Don't get it twisted. I'm not here to diminish the pain that people are feeling in their pocketbooks, their ability to provide for themselves and their children and their families. Don't mean to, if I'm coming off that way, I'm sorry. It is not intended, okay? It sucks. But it doesn't mean it's a recession, was what I'm saying. So and also, when prices are soaring, that's not necessarily a bad indicator of the economy either, okay? When an economy is, when prices are increasing, when the economy is running hot, when labor is able to get a bit more than usual because they have some leverage, you tend to see some increases in prices. Not that all the increases in prices right now, mind you, are because of that, okay? Some of it is because of stimulus spending. Most of it is because of supply, but some of it is because of stimulus spending. Some of it is because of things that are negative and the government has some control over, and etc. Okay. But it does mean that when you do have an economy that is going decently well overall, where labor is able to wrestle some concessions out of capital, you're going to see some price increases. And those price increases are going to suck, but it doesn't mean that the economy is in a ditch. Does that make sense? I hope I'm making sense here. I feel like I am, but I'm not getting direct feedback right now, so I'm just hoping that it comes off as I intend it to. So yeah, that's why it's a mixed bag. I don't like calling what we're experiencing right now a recession for that reason, and for the other reasons that it can become a self-fulfilling prophecy. If everybody is worried about a recession coming, if everybody is worried about the next 6 months to a year, people that have the ability to spend more are going to spend less. And that can cause an economic contraction on its own, even if everything else is going fine, right? Mostly fine. Even, despite inflation, people are still able to spend money, still going out and everything like that. Consumer spending still seems pretty robust. But if people start pulling back, that can have a cascading effect. Just like as the prices increase, people spend more money because they're worried about prices increases, and it can cause this inflation death spiral. You get the same thing with fears of a recession, where people start worrying about whether or not we're in a recession, and worried that we might go into recession in the coming months, so they spend less, and that less spending causes further reduction in spending, further reduction in job growth, and it keeps causing this vicious cycle. A lot of economics on the macro level is group psychology. It just is. It's vibes. And I don't even say that tongue in cheek. It is true. Behavioral economics is true. A lot of the things that we experience on the social level are, group psychology, group sociology, self-fulfilling prophecies, etc. And if people feel that things are getting worse and they react as if they're getting worse. Even if they're not getting worse, they get worse. So I don't like this hyping that the media is doing. All media, left, right, center, doesn't matter. All media is saying we're in a recession, we're approaching a recession, we're going to a recession. It's going to impact how people react, and it can create a recession even if we're not in one. That's the primary reason that's one of the reasons, probably the primary reason I am against not talking about the fact that things are getting slightly worse, but I'm against to say, I guess, overhyping it, I guess, to say overstating what is actually happening, because again, it can create this situation. Now, continuing on with this article, and this goes to buttress what I'm saying, Americans feel bad about the economy, and there's no doubt that soaring prices and everyday essentials are making it harder to get by. But a recession isn't a measure of how hard it is to make ends meet. It is defined by the NBER as a downturn that is deep, which we're not in right now, right? Diffused and lasts for a few months. Diffused meaning across the entire economy, and last a few months, which, typically speaking means 2 quarters, right? But there's no exact formula for a recession. For instance, 2 months in early 2020 were declared a recession despite being so brief, because the economy decline from the pandemic was so drastic and far reaching. 2 months rather than 2 quarters. We called it a recession because, again, the COVID hit, everything just fell off a cliff, all right? Everything went poof, down. So of course it's a recession, right? Even if it's short-lived. So, quote, every recession is unhappy in its own way, say David Wilcox, senior economist with the Pearson Institute for International Economics and Bloomberg Economics. It's important for the business cycle. It is important for the business cycle dating committee to shift through the indicators and make their decision in a flexible way. We took a look at where the indicators used by the decision makers at the NBER stand today, which is what I showed you, compared with recessions over the last 50 years. This year's economy is far from bulletproof, but is strikingly different from hard times of the past. Gross domestic product measures the country's economic growth by tallying up the value of all goods and services. It has declined in the past 2 quarters, but GDP often has big revisions after its initial release, averaging a full percentage point of changes between the first estimate and its final revision months later. The NBER also takes into account GDP's less prominent cousin, gross domestic income, which measures the same thing, economic growth, from a different angle. How much money was earned by making those goods and providing those services. In practice, the measures aren't quite equal. This year, they're pointing in opposite directions. GDP says the economy is shrinking, while GDI says it's growing. And GDI is inflation adjusted, which means that it is normalized to whatever the current, normalized to $1 in 1970 is equal to $1 in 2022, okay? Like it's equalized, it's normalized to 1, so you actually get a proper look about how it's going. Now in practice, averaging the GDP and GDI together, as the NBER does, suggests that the economy has largely stayed the same in the first 3 months of the year. Gross domestic income for the second quarter has yet to be reported. Employment shows a much stronger picture, especially when compared with previous recessions. The NBER looks at 2 different measures for employment: payrolls reported by businesses and direct household surveys. Both are big contrast with the jobs losses seen in the first 6 months of most previous recessions. There are signs that last year's frenetic labor market is easing. Jobs openings dipped slightly in June after months of record highs, and tech companies are slowing their growth, but unemployment remains at a pandemic low. Employment is usually a contemporaneous indicator, Wilcox said. If the overall economy was contracting, you'd see it in employment, and we're just not seeing it. So this is why all these signals are mixed, right? We're seeing some negative signs, we're seeing a lot of positive signs, a lot of negative signs, and it's causing this muddled mess that is indicative of not having a clear picture, but it's not quite indicative of being in a recession. So again, a recession that doesn't have broadly deep, broad reduction in everything, especially employment, isn't worthy of the name of a recession. And that is what I want to leave you here with.